Good morning, everybody. Mike Vacchi, PrincetonTrader.com here for NTMarkets.com with your Friday morning pre-market webcast. Okay, daily chart of the ES, and the uptrend resumes. We are back to business as usual, and there's a number of reasons for that, and I'll just give you the few key ones, at least on my stuff. 1890.25. Okay, and what we see happen is what the bears have allowed to happen so many times before. You get a bounce, okay, which is absolutely bound to happen on a strong move down from 72, or if you want to even say 85, the highs. You do 85 handles, 95 handles straight down. So you get a bounce. The bears then let that bounce morph into a multi-day rally that approaches key areas of resistance. And the bears have consistently been unable to turn key areas of resistance into actual resistance. You have potential resistance and actual resistance. There's always potential resistance on a chart. What the bears can convert into actual resistance is really very little, if anything. So, there were two areas of key potential resistance on the chart. The 50-day exponential moving average, which is depicted there by the red line, and the middle band, which is depicted by the green line. Middle Bollinger Band, which is the 20-day simple moving average. So on Wednesday, well, let me go back a little bit farther. On Monday and Tuesday, zoom in. On Monday and Tuesday, the red line, the 50-day exponential, was tested and held as resistance. The problem was, at the same time, the 23 area, 1923, became a floor in the market. And I've said before, and I've told my members, and I've said on this webcast, during the entire course of this uptrend, it has been built on floors. Floors being either immediate double bottoms that play out over a period of days, but make no mistake, you go back and look at the chart, you have floor after floor after floor that turns into new highs. When was the last floor? Let's see. Here we go. 1919, right here. 1919. June 13, June 16th, Friday into a Monday. Okay? 1923, August 11th and 12th. Now, the bears weren't done yet. They weren't cooked. All they had to do was hold the 50. Well, on Wednesday, they lost the 50 on a closing basis and closed just underneath the middle band. So that really put the pressure on. They had taken the market as far as they could take it, and what happens yesterday? They lose middle band. Bulls put in as strong a day as they needed to. They didn't need to park it. They just needed to protect, at that time, protect 47, which is middle band, and they closed above it. And what we've seen in the overnight is we've seen the market continue to march higher. A reversal here and making new lows is a very low percentage outcome. What is much more likely at this point is what we have seen time and time again, which is a test and a break above 1985.75. So I guess I'm calling for new highs. But what I'm calling for is for the market to do what it's been doing for the last couple of years. Nothing has really happened here, and certainly nothing has happened in the course of this upside price action since 1890 to suggest that anything is happening here except a resumption of the uptrend. So I'm long, going to play it accordingly. I didn't believe it. I gave the bears way too much credit the last 3 days, and I waited on doing things that I should have been doing when Monday and Tuesday, on Wednesday, should have just jumped in. I gave them an extra day, and this will still end up being a really nice long trade, but it could have been even nicer. Okay, that's all I got. Check us out on Twitter at Princeton Trader. Check out the website. Check out the chat room. Have a great trading day. Have a fantastic weekend. I will be back Monday morning with another webcast. Trade them well.